Ugandan shilling has been trading in a narrow range in the days that we've seen in the past few days, supported by slow demand for dollars among investors. Joining us on the line, James Matuku, Head of Financial Markets at Standard Chartered. James, thanks for joining us today. So I suppose we have looked at a region that has certainly been rocked by the terrorism attacks at the Westgate Mall, and certainly if you look at the Kenyan perspective, you have seen resilience in the markets, you've seen resilience in the currency there. And I suppose that's also transpired when you look at Uganda right now, where the currency hasn't really been affected to date by these attacks. But do you see rising risk premium being attached to the region as a whole? I mean, what are your thoughts as to how these the terrorism attacks could be perceived from a more medium-term perspective in terms of risk in the region?
Thank you very much. The attacks in Kenya were certainly very unfortunate. Our hearts and condolences go out to everybody that was affected with that on that attack. But what we see is that the Uganda shilling was not affected very much by the attacks that happened in Kenya. Actually, the Uganda shilling has been very stable. We have seen a slight depreciation today. Closing levels today were 25.70, 25.80. Slight depreciation from yesterday's closing levels of 2565.75.
Yeah. In light of that, we've also had strong demand coming through for bonds and for Ugandan paper. I mean, if you just look at the overall oversubscription there for the 2- and 5-year paper, total demand coming in at $170 million. The Bank of Uganda only wanted around $56 million. So certainly is a strong demand being reflected in that. I mean, what do you see as underpinning the appetite for paper right now?
I think this came about as a result of the Fed announcing that they were continuing with the bond buying program. I think we've seen a lot of impetus coming in from the foreign investors who are looking for high yields in Africa, and certainly the yields in Uganda have been very good traditionally for the fund managers offshore. So yeah, that flow, that foreign currency flow has really helped in stabilizing the Uganda shilling.
I mean, how sustainable are these flows right now? Because, I mean, it's all been around the surprise announcement that the Fed is still going to keep pumping $85 billion into the bond market on a monthly basis. You know, that the surprise really is that they're not withdrawing from the markets as yet. But at some point in time, we know that the Fed is going to start pulling back on quantitative easing. I mean, where does this put a country like Uganda as still very reliant on those flows into the bond market?
That is certainly a very real risk. But when you look at the Uganda yield curve in East Africa, the Uganda yield curve has traditionally had higher rates compared to Kenya and Tanzania, and therefore, traditionally Uganda, we've seen a lot of fund manager flows, foreign portfolio flows, looking for higher yields in Uganda. Mm-hmm. In the long term, I think as the oil sector, oil and gas sector comes on board in Uganda, then we will probably see these short-term flows replaced by more stable long-term flows, and if you like, foreign direct investment into the oil and gas sector in Uganda. So, and you rightly say, as the Fed, we expect the Fed program to start ending around 2015, and by that time, I think the oil and gas sector in Uganda would have come on board.